Tesla. So actually, let me just go back here a little bit. AI. Okay. Now, if there's one guy that you want to know about AI, it's Jim Chanos. Am I right? The guy who doesn't believe in NVIDIA or Tesla will explain to us why AI is a big doomsday scenario. Let's see. Okay, so I take it you haven't. let's just hear what he has to say. There's some interesting context here that I want to provide.
We were talking before we went to break about the era of AI.
Let me know if the audio is okay.
What kind of opportunities has this opened up as someone who looks at the market with a very critical eye?
Well, I think anytime we see one of these tectonic shifts in new technology, like the internet in the 90s, people at first embrace everything. Everything is going to benefit. But what you find out, of course, is that when it's truly a major shift, is that those technologies end up harming as many businesses as they create. And so
would you say that the internet has harmed just as many businesses as it's helped over the lifespan of the internet? I don't know, man.
If you think about the companies that were in the business of distributing analog physical products.
We should look into this. Larry asked a good question. How did Chanos get so rich? We should do a Wikipedia deep dive after.
Products that became digitized, they went away. Blockbuster Video, Eastman Kodak. I mean, companies like that, record stores. I mean, and I suspect that if AI is as big as most people think it will be, you will see lots of businesses that had moats find out that the moats have been breached. So your software as a service, what prevents a corporation from having AI design its own software for various?
He says that like it's a bad thing, you know? It's like, look, if AI is like fire, right? This is the analogy I kind of look at AI with. AI is kind of like fire. Of course, arson, burning people, burning yourself. There's a million bad things that you can do. But if fire is contained in a fireplace, it can warm up your entire house.
There's different applications, right? And there's lots of things that suddenly you don't think about. I kind of joked a little bit a few months ago when IBM's CEO came out and said that AI may make some of the IBM workforce redundant. And I joked, well, what happens when the clients find that same thing out?
Yeah.
Okay, so he's saying AI is going to replace a lot of people. People are going to be pissed. Look, I mean, any technology is going to have a displacement effect on the workforce, but the theory being that those people can be freed up to do more productive things for society. This whole doomsday narrative about AI is it's very typical of Chanos, in my opinion, to have it, but it's just I don't know.
I mean, that's a really good point. I want to shift gears a little bit and talk about your strategy around shorting and what you're seeing in the market today. I think a lot of people, of course, understand your history with being a fraud hunter and going after companies like Enron in the past. I'm wondering if over the last few decades, with regulatory changes, you've seen fraud reduced, or are there increased instances of potential fraud out there?
I've called this the golden age of fraud. I think there's more fraud in the financial markets now than there has ever been.
Why?
And I teach a course.
By the way, so Tesla Q, essentially, a big portion of Tesla Q like to frame what they're doing as fraud hunting. They're looking out for the next fraud. And the reason for this is quite simple. When you're a bear, when you're a skeptic, and you're generally considered, and people are looking at you as you're like your theory is wrong for many, many years, and then you're proven right very fast. Example, Enron, right? People that were calling for the real estate crash of 2008 years prior, after the Big Short, classic example, after they're proven right, after being made fun of for so many years, the amount of notoriety that you get is disproportionately higher than if you're a bull and you cheer on new tech, and let's say you lose 4 out of 10 of the theses that you have, but you hit on 6 out of 10. You don't get the same amount of credit in media, in investor base, than you do when you are anti something and you're proven right. So what ends up happening is a large portion of people like to frame what they're doing as fraud hunting or investigation in the hopes that one of these theses is proven right and they get the amount of notoriety that they need. Right? Of course, Chanos is tied to Enron. So there's that. Big Short, Michael Burry. But the amount of credit that that Wall Street or investors start to give you when you protect them, and it's just basic risk aversion, right? As humans, we are, it hurts us more in the magnitude to lose $10 than it does for us to make 20, right? There's something about that loss aversion that we have. And so you have people like Chanos, you have people like Tesla Q. I'm not going to name people. You have people like Michael Burry who are out there in the hopes that they can catch one of these quote unquote frauds out there, be proven right, and then live eternally in the Hall of Fame. That's all it is. And of course, Tesla defies logic. A lot of the times it will defy logic. Amazing news, Tesla's down. Terrible news, Tesla's up. So it really is easy to feed into the day-to-day narrative on this sort of stuff. Anyways, let's continue. Rich says, as it turns out, on my live stream tonight, we've had a short killer on to talk about the immorality. There we go. Folks, what is wrong with me on Sunday morning is something about it. Immorality of shorting, and it's anti-progressive. We can have this whole debate actually about shorting as well.
Of course, on the history of financial market fraud. So
I need some
the
coffee.
cycles go back to the late 17th century. I think that it always changes, but what really has me bothered now is that a lot of it hides in plain sight in the way in which companies report their business and their metrics. So prior to say 10 years ago, you really had to sort of, if a company was making unusual changes to its earnings statements, they would have to explain it away. And nowadays, adjusted earnings are basically the norm. And companies add back all kinds of things that they don't really
It is a little wild.
care expense. Oh, it's amazing. Coinbase, in the fourth quarter of last year, I think share-based comp was almost 80% of revenues. And they just added it back.
I mean,
and so it's,
we go back to the why WeWork didn't go public.
Okay, screw WeWork. We don't care. Let's get to the Tesla part. It starts right at 13 minutes. Let's see what
it
happens.
behooves you to basically hear both sides of any story.
We'd be remiss if I didn't ask for an update from you on Tesla. Shares up 124% this year.
He can't help to laugh. Look at his face. He is. That's the laugh. The laugh that like someone's laughing and they have like a little thing on top of their face, but they're actually crying behind it.
Yeah, we are short Tesla. We remain short. It's one of our 44 positions that we have. Look, Tesla is in many ways, I think, epitomizes this bull market. It's a hopes and dreams stock. It's trading at 75 times earnings, which aren't growing anymore. It looks like revenues are going to be challenged in terms of growth. So it's now, again, an AI story or a robo-taxi story or a battery story or a robotics story. It's whatever you want it to be. And it reminds me a lot of Cisco back in 1999 and 2000, wow, where Cisco was a networking company. Tesla is a car company, but Cisco was going to get into everything else that had anything to do with the internet. And people put a higher and higher multiple on it. And ultimately, Cisco did okay, but the stock price, dropped 90%.
So the bar he's setting is that he doesn't, pretty much what he's implied there. He doesn't ever think Tesla is hitting all-time highs again. And if anything, he thinks that it'll be dropping substantially from here. Yeah, that's a good catch, actually. He says 44 short positions. So again, this is my point. People like this get notoriety, disproportionate amount of notoriety from being short and being right rather than being long and being right. There's a degree of this. Where can we get that cap? Shipped to Europe? I do think I shipped to Europe. TSLAGG.com. Is it in the description? I'm not sure if it is. Check it out. Thank you. You haven't hit that bit until you hit that like. Push that burn. Thank you.
I'm going to do a quick lightning round of some stuff that has been reported that you are or have been short recently. Just have me yes or no's if you're still short.
Ooh. Okay. Short or not. By the way, there's a good debate happening in the comments about shorts, whether shorting should exist. Let's have this debate right after this clip. Oh, whoops. Don't want to download.
Digital Realty Trust,
We are short the data centers.
SL Green Realty.
SL Green is, we are short commercial real estate.
Okay. Tesla, you said. Sunrun, you said.
The solar leasing companies, I've called them science projects. They're absolutely hysterical. They lose hundreds of millions of dollars, huge negative free cash flow. And getting back to our early conversation about metrics, they report rather than a regular P&L, which would be embarrassing. They report these net present value calculations based on the panels they put up on people's roofs, and it's absolutely hilarious the way they do it. And I think investors are going to find out the hard way about it.
All right, Jim, we're going to spend the last 40 seconds with you getting your thoughts on what you're watching, what you're streaming, what you're doing, and what you're seeing at the movie theater. New movie out, Dumb Money. It's got Pete Davidson in it. It's got Seth Rogen in it.
All right. In case you wanted to get Jim Chanos' movie recommendations, you can watch the end of that. But as you guys know, I don't watch movies. I'd rather sit at home and do that. Okay. So what's interesting, there's a really good debate happening in the chat right now, and it's about should shorting exist? And a lot of people feel like shorting should not exist. Elon's on the record to say shorting should not exist. His logic is very simple. Can you short private companies? No. So why should you be able to short public companies, right? Pretty much that's his thesis. And the problem with shorting is that you can have a bunch of bad actors pool up together, short the crap out of a company, bringing it to bankruptcy. That's the problem with shorting. The upside to shorting is hedging. If you're an investor and you want to hedge a position, and maybe you want to be long this index, but you want to be exclusive of this company, a la Bill Gates type shorting, then you can do that. The problem, of course, with shorting is that it does drive down stock price. And essentially, if the stock is relying on the stock price for funding, for liquidity, there's an issue there. Of course, naked shorting is an entirely different problem altogether as well. My opinion is that if you want to hedge, options exist for a reason. That's why puts exist, right? That's why calls exist. Calls and puts, everyone likes to talk about options. And I chatted about this with Brian on my Tesla Weekends channel about options. But I said, look, like options don't exist just so we can be degenerate gamblers. Options exist so people can sell covered calls on their equities. Options exist so people can implement roll strategies to get into positions or buy insurance, right? Options are insurance, both on the long and short side. So options, though they do have a derivative effect on stock price, it's not to the same effect, or it's not to the same magnitude that legit shorting does. He says this guy. Good one. Okay. Shorting has its place in the market, Jay says. And so there's this debate that I think we can have. Rich says it's not just drives prices down, but it kills companies. And that's the issue. If you're a small enough company, you can 100% get killed by shorting. That 100%. Very true. And again, this is Tesla's story in the early days, of course. And that's why Elon is so anti-shorting, is because when you can have predatory shorting. That is the issue. Predatory shorting. When a bunch of bad actors get together and they look at a company and they go, this company is so close to bankruptcy. If we all got together and we just shorted this a little bit and we put out some sort of FUD, the stock would crash, go to zero. This company would be nada. And especially if they don't like the person running it, maybe they have some ill will towards them. Maybe they just look at them and they're jealous and they get insecure about themselves. And then they can target companies like that. And of course, Tesla was a prime example of this in the early days, very close to hitting bankruptcy. It's very easy for that to be a problem. So, J Cam says, VinFast is a great example why shorting should be allowed. So interesting theory there, right? VinFast is Vietnamese EV car maker, whatever thing, hit like $400 billion market cap very fast. And actually, that's actually a really good point. Before we get into our next topic, let me just pull up VinFast stock. So VinFast stock is currently sitting at $17. It was at a high of $82. All right, folks, at the end of August. Insane. Okay. Insane. Since the highs, it's down already 78%. And the thing is, options exist for this. So you could, or it did. So you could, in theory, have bought puts bought puts, sold calls, that sort of thing, if you really wanted to. But with a market cap of $40 billion, and I'm not even sure what their revenue is, VinFast revenue, it's confident about a $2 billion revenue forecast this year. It's trading at 40. So that's whatever. But when it was trading at, what was this? So 80. So let's say times by 4. So $160 billion market cap. Yeah. McFly says shorting's fine. Then the downsides, as you just mentioned, exist in being long also. Well, here's the thing about being long. You can never screw someone by being long. By being long, you're an investor in a company and they get increased stock price, increased capital, increased liquidity with their stock. The issue with shorting is that you bring the stock price down, but then also you can bring it down to a cap, right? Like stock prices can only go down to zero and before they get bankrupt. And so the issue with shorting is that there is an arbitrary, quote unquote, arbitrary $0 price target that if you hit, you essentially screw the company. Realistically, it's not actually zero. It's some number greater than zero at which the stock is just disgustingly low and no one wants to touch it anymore. And essentially that spirals the company downwards. But with going long, I mean, yeah, you can go long to infinite. I mean, it doesn't really matter. And I guess it only helps people that are invested in the company. So you don't have that same level of responsibility on both sides. I mean, it's a very, very, very interesting philosophical debate that we can have about shorting. And super cool that you guys are interested in this. Yeah, well, we can get into the insider stuff. I'm not too well versed on VinFast in particular, I will say. So, Jan says, even if an exchange doesn't allow shorting company, what is to prevent me from privately approaching a shareholder and privately arranging a short? Same for a private, non-public company. Well, I just don't know how you would do that. Like you would go up to a CEO of a company who would say, hey, can I borrow some of your stock from you? And I promise to buy it back later when the price is lower. I mean, you'd kind of get laughed out of the building. It just wouldn't, in theory, happen. Because if the CEO is willing to let someone open up a short against his or her own company, I mean, I just don't know in theory if that's something that actually would ever happen. So anyways, very, very good chat. Look at all the comments in here. Squeezed in here, Bill says, is Tesla due for another gamma squeeze? I was thinking about that the other day, and I'll explain why here in a second. Let's see. Okay, interesting.